Welcome to TalkTickers. We're diving straight into Barclays' latest earnings call today. Our goal, to break down what really matters for you from that call. We've sifted through it all.
And it looks like a strong start for Barclays in 2025. They're definitely showing progress on that 3-year plan they laid out.
Okay, so what are the headline numbers? What jumped out?
Well, the big one is probably the return on tangible equity, the ROTE. It came in at 14% for the first quarter.
14%? That sounds pretty good. How does that compare?
It's a solid jump. Last year, same quarter, it was 12.3%. So yeah, definitely moving in the right direction in terms of profitability.
Right, a clear improvement there. Yeah. And other key metrics, what about book value?
Tangible book value per share also saw good growth, up 11% compared to last year, hitting 372 pence.
Okay, 372p. So the underlying value seems to be building. How about the top line, the income?
Total income was £7.7 billion for the quarter. And they made a point of saying the quality and stability of that income have improved.
Quality and stability, always good words to hear. Did efficiency improve too?
Yes, they achieved positive operating leverage of 6%. Basically, income grew faster than costs.
Ah, the magic formula, income up, costs. Well, relatively down.
Exactly. And that feeds into the cost-to-income ratio, which landed at 57% for the quarter.
57%. So looking ahead, are they feeling confident about the rest of the year, sticking to targets?
They seem quite confident, yes. They're reiterating that target of around 11% ROTE for the full year 2025.
Okay, holding firm on the full year ROTE.
And more than that, actually. They've upgraded their net interest income guidance, the NII.
Oh, really? That's interesting. Where are they seeing that extra NII coming from?
It's across the board, but particularly Barclays UK. The guidance there is now over £7.6 billion, up from about £7.4 billion previously.
So the core UK bank is doing better than expected on lending margins?
Sort of. It seems to be more about deposits, actually. They said deposit trends were stronger than they anticipated.
More deposits coming in or sticking around longer?
A bit of both, it sounds like. Higher seasonal volumes in current accounts, and the mix of deposits stabilizing faster than they thought. That's helping support the NII.
Got it. And what about the group NII guidance, excluding the investment bank?
That's also up, now expected to be over $12.5 billion compared to the previous guidance of around $12.2 billion.
Okay, so positive momentum on the NII front. We often hear about the structural hedge. How's that playing into this?
Yeah, the structural hedge is becoming even more significant. It's now locked in $10.2 billion of gross income over the next 2 years.
Wow, $10.2 billion? Up from what?
Up from $9.1 billion last quarter. And they expect to reinvest about 90% of the hedges that mature over 2025 and 2026.
Right.
So that provides quite a bit of, income visibility.
Right, locking in those rates provides a buffer. What about the investment bank? How did that perform? It can be quite volatile.
It actually had a strong quarter. Income was up 16% year on year.
16%? What drove that? Trading?
Mostly, yes. Strong activity in markets, especially fixed income and credit trading. It seems the market volatility actually helped their trading desks.
So while maybe M&A and deal-making were a bit slower.
Exactly. They mentioned weaker client confidence delayed some investment banking transactions, but the trading revenues more than made up for it.
Interesting dynamic. What about the U.S. consumer bank?
The ROTE there was 4.5%. Management said operational performance is sort of progressing as expected.
Just as expected. Okay.
Yeah, and they highlighted the new partnership with Brookfield for the payments business. They see that as key for enhancing client experience and driving, long-term growth and better financial performance over there.
Okay, transforming payments. Let's pivot to the cost side. You mentioned positive operating leverage, but what's happening with absolute costs?
Well, they did deliver $150 million in gross cost savings in Q1. That's part of their $500 million target for the year, aimed at structurally improving the cost base.
So hitting their savings targets.
On track for that, yes. The goal is a cost-to-income ratio of about 61% for 2025, and then into the high 50s for 2026.
But overall costs did tick up year on year, didn't they?
They did, yes, by $189 million. But there are specific drivers. About half of that increase relates to bringing Tesco Bank onto the books, just the ongoing running costs.
Ah, the Tesco integration costs?
Right. And there was also an employee share grant expense in Q1 that contributed.
Okay, that makes sense. Now, let's talk risk. Asset quality impairments, Any warning signs there?
The group impairment charge was $0.6 billion. Yeah. That translates to a loan loss rate of 61 basis points.
61 basis points. How does that stack up against their guidance?
It's slightly above their through-the-cycle guidance, which is 50 to 60 basis points.
Okay, a little elevated. Why is that?
It seems driven by a more cautious stance, particularly regarding the U.S. economy. They've adjusted their IFRS 9 models.
Adjusting the models, what does that mean in practice?
It means they're increasing the probability weighting they give to potential downside economic scenarios in the U.S. So thinking about things like higher potential unemployment or lower GDP growth than, say, the consensus forecast might suggest.
So they're proactively provisioning more, even if the defaults haven't happened yet.
Exactly. It resulted in a net post-model adjustment of $74 million in Q1. About $38 million for U.S. cards, linked to higher peak unemployment assumptions, and $36 million in the investment bank, linked to lower U.S. GDP growth assumptions.
So a cautious overlay on the U.S. outlook. What about the U.K.?
In the U.K., the loan loss charge increase was mainly due to adding Tesco Bank. There was about a $30 million charge related to just migrating those acquired loans onto Barclays books and staging them appropriately.
So ex-Tesco, the core UK book is okay.
Yeah, ex-Tesco, the loan loss rate was only slightly up and remains low. And importantly, they noted that delinquency rates in the U.S. consumer bank were stable in the quarter.
Okay, stable delinquencies currently, but building provisions for potential future bumps. Let's look at the balance sheet strength, capital.
Very solid. The CET1 ratio came in at 13.9%.
13.9%. That's strong, right? Where does that sit versus their target?
It's right towards the top end of their 13-14% target range. So plenty of capital buffer.
How did they get there? Profits minus buybacks?
Pretty much. Capital generation from profits, plus a boost from selling their German consumer finance business. That was partly offset by the share buybacks they've been doing.
And risk-weighted assets, RWAs?
Those actually decreased slightly from Q4, down about $7 billion to $351 billion.
Okay. And liquidity?
Looks strong, too. Loan-to-deposit ratio is comfortable at 73%, and the net stable funding ratio, the NSFR, is 136%. So yeah, good liquidity position.
Right. And that tangible net asset value we mentioned earlier, that ended the quarter at 372p.
Correct. Up 15 pence during the quarter itself.
So overall, a picture of strengthening capital and book value. What does this Q1 performance tell us about their strategic direction? Are they sticking to the plan?
It seems so. They reiterated confidence in the 2025 guidance and the 2026 targets, including that circa 11% ROTE this year and progressive capital returns.
And the focus remains on
shifting capital towards the higher returning UK businesses, while also working to improve returns in the investment bank and the US consumer bank.
Right, rebalancing.
Yeah, and the Tesco Bank integration seems to be going smoothly. They expect that to contribute more to NII. They also flagged strong UK mortgage lending in Q1.
And the investment bank strategy?
Aiming for higher, more consistent returns. Q1 showed they can benefit from volatility with strong results in fixed income, FIC, and equities trading.
And U.S. consumer.
Focus there is on boosting digital adoption, driving efficiency, and they mentioned strong retail deposit growth, which is a positive sign.
Okay, so let's try and wrap this up for someone listening. If you're an investor or just following Barclays, what are the main takeaways from this quarter?
I think the first thing is that these results suggest Barclays is executing on its plan, even with, the economic backdrop being a bit uncertain.
Execution seems key.
Definitely. Second, the upgraded NII guidance is a clear, positive signal, especially about the core UK business and how they're managing deposit flows.
Right, the engine room performing well.
Third, the investment bank's performance shows its ability to, make money from market swings. That diversification is important for investors to consider.
Yeah, the trading offset the quieter deal environment.
Fourth, those increased impairment provisions in the U.S. While they signal caution about the future, it's important you understand it's proactive, not a reaction to current problems with borrowers.
A prudent move, perhaps.
Possibly. And finally, that robust capital position, 13.9% CET1, gives them a lot of flexibility for future investments, potential M&A, or returning more capital to shareholders down the line.
Plenty of firepower. Okay, great summary. Now let's shift to our final segment. Time for some outrageous but plausible trade ideas sparked by this earnings call. And of course, the big disclaimer, this is absolutely not financial advice, just some food for thought. What have you got for us?
Okay, idea number one. Given that strong deposit growth in Barclays UK, the upgraded NII and the stability from that big structural hedge, you could potentially consider a long position in longer dated UK gilts.
Long gilts. Explain the thinking there.
Well, the idea is if Barclays' own experience of strong deposit inflows is perhaps indicative of a broader trend, or if it helps keep funding costs contained, it could put downward pressure on longer-term interest rates in the UK market. If that happens, the price of existing longer-dated gilts would rise. You're essentially betting that the factors boosting Barclays' NII might also be favorable for government bond prices.
Interesting. Riding the coattails of their core UK strength, but in the government bond market. Okay, plausible, if a bit out there. What's idea number 2?
Right. Second one focuses on the investment bank. We saw strong trading revenues helped by volatility, but maybe a slower outlook for traditional M&A and IPOs, right? So consider a pair trade. Go long volatility, maybe via an index like the VIX, betting on continued or future market choppiness.
Okay, long vol.
And simultaneously short a basket of other investment banks that are perhaps more reliant on those traditional advisory fees, the M&A and IPOs. Crucially, you'd exclude Barclays from that short basket.
So betting on volatility, which might help Barclays trading, while betting against banks more exposed to a potential slowdown in deals.
Exactly. It's a way to potentially capitalize if market turbulence continues, benefiting Barclays' trading arm relative to peers, while hedging against a scenario where deal-making stays subdued for a while.
A classic pair trade structure playing on Barclays' specific strengths within the sector. Okay, definitely some creative thinking there. But as we always say, these are just thought experiments. Please do your own detailed research before ever considering any investment.
Absolutely. So to wrap up, Barclays put up a solid Q1. Strong income, positive operating leverage showing good cost control relative to income, and that improved NII outlook. Management sounds confident despite the economic uncertainties. It shows a resilient, diversified business model at work.
A resilient first quarter indeed. That concludes our deep dive on the Barclays earnings call. As always, we're interested in your take. What caught your attention? Any questions still lingering for you? Let us know. Until next time, keep digging deeper and stay informed.